Late 1990s. America logs on. The internet hums through phone lines. Modems scream. Web pages load line by line. And yet, somehow, the future feels instant. For the first time, you can shop, talk, invest, and explore through a glowing screen. It feels revolutionary, limitless, inevitable. It was a trap dressed as destiny. A new world is loading, and everyone wants in. This isn't just a stock market rally. It's something stranger, a collective belief that the old rules no longer apply. No profits, no plan, no problem. Because this time, they say it's different. The birth of a digital dream. For decades, investing followed boring logic. Companies made products. Products made money. Money justified stock prices. Then came the web. Suddenly, businesses didn't need factories, warehouses, or inventory. All they needed was a domain name ending in .com. Investors were told profits didn't matter anymore. What mattered was growth. Eyeballs, clicks, traffic. Revenue could come later. Losses were strategic. Burning cash wasn't failure. It was investing in the future. Wall Street didn't just accept this logic. It embraced it. And once the story was accepted, the numbers stopped needing to make sense. The signal flare. In 1995, Netscape went public. It wasn't a profitable company, but its stock didn't just rise, it exploded. That IPO was a signal flare, a message to every founder, investor, and speculator watching. The gates are open. From that moment on, Silicon Valley turned into a gold rush powered by fiber optic cables. Venture capital flooded in. Ideas scribbled on napkins received millions in funding. First mover advantage. Winner takes all. If you're first online, you own the future. Or so they believed. Venture capital meets fantasy. Startups hired fast and spent faster. Lavish offices. Free food. Stock options instead of salaries. Companies ran Super Bowl ads before earning a single dollar. Mascots became brands. Pet food was delivered overnight, at a loss on every order. But no one cared, because every IPO felt like a jackpot. Employees became millionaires on paper. Day traders quit their jobs to stare at glowing screens all day. Taxi drivers gave stock tips. That's when bubbles form, when everyone feels like a genius. The system didn't reward caution. It rewarded belief. IPO mania. Companies went public years before they were ready, if ready even meant anything anymore. On opening day, stocks doubled, tripled, sometimes quadrupled. The NASDAQ didn't rise. It launched. From under 1,000 in 1995 to over 5,000 by early 2000, a five-fold explosion fueled not by earnings, but by belief. Belief that the internet had rewritten economic gravity. And gravity hates being ignored. The new math of make-believe. Traditional valuation no longer mattered. Price-to-earnings ratios? Useless. Many companies had no earnings at all, just losses. So Wall Street invented new metrics. Price per click. Value per user. Revenue potential per eyeball. It was financial astrology dressed as science. If a company lost money, it was investing aggressively. If it lost more money, it was scaling. Reality was postponed indefinitely. The media echo chamber. Business media joined the frenzy. Magazine covers crowned young founders as visionaries. TV anchors announced each IPO like a cultural event. Skeptics were dismissed as dinosaurs. You just don't understand the internet. Even traditional companies with real profits were abandoned for digital dreams. Value investing was dead. Clicks were king. And questioning the story felt almost offensive. The warning signs no one wanted to see. Beneath the hype, cracks were forming. Most .coms had identical business models. Sell something online cheaper than everyone else, forever. Margins were negative. Customer loyalty was thin. Competitors were one line of code away. The same technology that promised dominance also guaranteed brutal competition. But the music was still playing, and no one wanted to leave the dance floor. The turn. In early 2000, reality tapped the market on the shoulder. Interest rates began to rise. Capital became slightly less free. Investors started asking dangerous questions. When you make money, what happens if growth slows? Why are losses getting bigger? The answers were vague. Confidence cracked, and stocks stopped going up. As long as prices rose, questions didn't matter. But markets don't crash on answers. They crash on questions. Gravity returns. Once prices stalled, belief evaporated. A few earnings disappointments triggered sell-offs. Sell-offs triggered panic. Panic triggered margin calls. The NASDAQ began to fall. Slowly at first, then violently. Companies that had never made a profit suddenly faced something worse than losses. No funding. Cash ran out. Layoffs followed. Office lights went dark. The collapse. Between March 2000 and October 2002, the NASDAQ lost nearly 80% of its value. Trillions of dollars gone. Inside glass offices, engineers packed cardboard boxes. Stock options that once paid for dreams now paid for nothing. Paper wealth doesn't bleed. People do. Pets.com shut down. Webvan collapsed. eToys vanished. Names once synonymous with the future became punchlines. Employees watched stock options turn into wallpaper. Investors saw retirement plans evaporate. The dream logged out. Survivors and scars. Not every company died. A few, like Amazon and eBay, survived by doing something radical. They learned how to make money. Amazon stock fell more than 90%. Jeff Bezos was mocked, called reckless, delusional. But the company cut costs, focused on logistics, and waited. The bubble didn't mean the internet was useless. It meant expectations were insane. The aftermath. The crash didn't just destroy companies. It rewired psychology. Venture capital froze. IPO markets shut down for years. For a while, saying .com was an insult. There was little outright fraud, mostly delusion. People weren't lying. They were believing. And belief can be more dangerous than deception. The deeper lesson. The .com bubble wasn't about technology. It was about narrative. A story so powerful it suspended skepticism. A belief that progress had canceled fundamentals. Every bubble believes it's different. Every generation thinks it's smarter than the last. Until gravity returns. The echo. Years later, the pattern returned. New words replaced old ones. Disruption, network effects, user growth, vision. Different decade. Same psychology. Markets don't run on math alone. They run on stories. And the .com bubble proved something uncomfortable. Innovation doesn't cancel fundamentals. It just tempts us to forget them. Technology can change how we live, but it doesn't change human nature. Greed still accelerates. Fear still crashes. And belief still inflates prices faster than reality can support them. That mistake didn't end in 2000. It just learned new names. The .com bubble didn't burst because the future was fake. It burst because we priced it as if risk no longer existed. If you want more breakdowns of financial manias, collapses, and economic myths, like and subscribe. Oh, and if you're curious about another crisis, watch this one next.